I have a question for you, and I want you to notice your immediate physical reaction when I say this.
Okay, I'm ready.
The phrase is annual report, or even worse, the technical term, Form 10K.
Yeah, okay, I see what you mean. For most people, it's probably a heavy sigh.
Exactly.
Maybe, spike in cortisol, the eyes glaze over a little bit, and you suddenly have a very strong desire to go do the laundry.
Literally anything else. It feels like homework. I just picture this 200-page PDF written by lawyers for lawyers.
Yeah.
It feels like a barrier to entry.
It absolutely does.
Yeah.
And look, that barrier is real. We know the answers we're looking for are in there.
Right.
If you really want to understand a business, I mean, the actual engine, not just the stock price bouncing around, you have to go to the source.
Yeah.
But you open it, you see page 1 of 180, and you freeze.
It's the sheer length. You think, I do not have time to read a novel about accounting.
Right. But, and this is why we're doing this deep dive, it turns out we might have been doing it all wrong.
Yeah.
Or at least the hard way.
We have.
Most people try to read it linearly, like a book. Start at the beginning, try to plow through to the end. That is just a recipe for burnout. You'll be asleep by page 10.
So for this, we are decoding the 10K. We're basing our strategy on the work of investor Hamish Hodder, who has a method that proves you do not have to read from page 1 to 180.
That's the whole key.
Yeah.
It's about being strategic, not exhaustive.
Yeah.
You're not proofreading. You're an investigator. You're mining for specific nuggets of gold and, ignoring all the dirt around it.
And to make this real, we're not just going to talk theory. We're walking through a real-life example that Hamish uses, the restaurant chain, Texas Roadhouse.
Which is a perfect case study. It's a pretty simple business on the surface, steaks, rolls, margaritas, but the 10K still hides some fascinating stuff you'd miss otherwise.
Okay, so let's get into it. We have the strategy, we have the steakhouse, but before we zoom all the way in on one single company, it's probably smart to take a quick step back.
Mm-hmm.
Because even a great company can get hammered if the entire market is overheating, right?
That is so true. Context is everything. You can have the best ship in the world, but if the whole ocean is boiling, you're still going to have a bad time. You have to know the temperature of the water.
To track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
Yeah, Chet's Apple steers good.
It is always good to have that macro view. It just anchors your expectations.
It does. But now let's get back to the micro. Back to that daunting PDF.
Right. Step 1 is just getting the thing. I usually just Google the ticker symbol and kind of hope for the best.
And that works for headlines. But for the 10K, you want the real deal. No summaries. You go to the company's investor relations page. Or, for the totally unfiltered source, the SEC filings page. Look for annual filing, or 10K.
Okay, I've downloaded it. It's on my desktop, mocking me. I open it up. Where do I go first? The numbers.
No, absolutely not. Put the calculator away for now. Your first stop is almost always item 1, business.
Item 1. Very creative naming.
Very. But think of this section as the company's encyclopedia. If you were an alien who just landed and needed to understand how Texas Roadhouse makes money, this is where you'd go.
Covers everything.
Marketing, sourcing, who their competition is, all of it.
Now, here's where I get bogged down. If a company's been around for, say, 20 years, do I need to read item 1 for every single one of those years?
No, and this is the first huge time saver. You only need to read item 1, business, thoroughly for the current year.
Just the most recent one. Isn't that risky? What if I miss something important from their history?
Well, think about it. The fundamental model of a steakhouse doesn't change that much from 2015 to 2016.
Right.
They're still selling steaks.
Right.
So you read the current one to get the full manual. For the last 10 years, you just glance at them. You're just skimming to see if there was some massive fundamental shift.
Like what, for example?
Like, in 2012, we were actually a seafood shack. Or in 2015, we pivoted from owning all our stores to franchising them all. Big stuff like that. If it looks the same, you just move on.
Okay, that makes so much sense. That saves hours. So in the Texas Roadhouse example, what kind of gold are we actually finding in item 1? It's got to be more than we grill meat.
Oh, much more. For instance, in the report Hamish looked at, he found the store count breakdown. And it wasn't just Texas Roadhouse restaurants. They have another brand called Bubba's 33.
Bubba's 33. I've never even heard of that. I just assumed they were a one-trick pony.
Exactly. See, that's a detail you'd never get from a stock chart. You suddenly realize, they have another potential growth engine here. But here's where it gets really valuable. Item 1 gives you the unit economics.
Unit economics. So breaking it down to one single restaurant.
Correct. In this case, the report stated, almost as a throwaway line, that it cost them approximately $5.2 million to open one new restaurant.
$5.2 million. Okay, that's a very specific number. But why do I, as an investor, care about the construction cost of a building in Ohio?
Because That number is the I in ROI. It's the investment.
Ah, okay. Walk me through that.
If you know it costs $5.2 million to build the machine, and then later in the financials, you see the average machine spits out, say, $1 million in profit a year.
Then you can do the math. $1 million in profit on a $5.2 million investment. That's what, almost a 20% return?
It's a fantastic return. But you wouldn't know if that $1 million profit was good or bad if you didn't know the cost to build it. If it cost $20 million to build, that same profit is terrible.
Right. So without that number from item 1, I'm just looking at profit in a vacuum. I don't know if it's an efficient profit.
Precisely. You're just guessing. Item 1 anchors the numbers to reality. You'll also find how they pick their sites, their food standards, everything. It sets the whole baseline.
Okay, so we've established what the business is. Now we have to look at what could kill it, which brings us to item 1A.
The risk factors.
This is the section where the lawyers go wild, right? Covering every possibility. If an asteroid hits the Earth, our sales may decline.
There's a lot of that, yes.
Yeah.
A lot of boilerplate stuff. But this is management's list of everything that could stop them from hitting their goals. It's the reality check section.
What's the strategy? Just read it once.
Exactly. Read it thoroughly one time. The risks don't change that much year to year. You're trying to filter out the generic stuff, like the economy might get bad, and find the specific risks.
Okay, so for a restaurant, what's a specific risk?
A specific risk would be disease outbreaks in cattle, or minimum wage hikes in the specific states where we have a lot of restaurants.
Ah, I see. Things that are unique to their business model.
Right, not just things that affect everybody. You need to know their specific nightmares.
Okay, we know the business, we know the nightmares. Now we get to what Hamish calls the crown jewel of the annual report.
The MD&A, Management's Discussion and Analysis.
That title sounds so incredibly dry. Management's discussion. Why is this the juicy part?
Because this is arguably the most important section in the whole document. If the financial statements are the what happened to revenue, what happened to margins, the MD&A is the why.
So the spreadsheet tells me the numbers and the MD&A tells me the story behind them.
Or the excuse. Why did margins shrink? Was it beef prices, labor? Why did revenue grow? Did they just hike prices, or did they sell more steaks to more people?
That is a huge distinction.
It's everything. And this is where the strategy changes. We're not just reading the current year anymore.
Right. This is where we do the time travel. I love this idea.
To really understand a management team, you can't just listen to them today. Anyone can sound brilliant in a good year. So you go back, you read the MD&A for 2010, then 2011, 2012, all the way up to today.
That sounds like a lot more work than the other sections. What am I looking for specifically?
You're tracking honesty and competence. You are basically building a psychological profile of the CEO over a decade.
Give me an example of how that works.
Okay. In 2012, the MD&A says, our big new strategy is to expand into the Northeast. Then in 2013, they say, it's going great. Then you open the 2014 report and they say, we're closing all our Northeast locations.
The moment of truth.
Exactly. How do they explain it? Do they own it? Do they say, look, we misjudged the market, here's what we learned? Or do they just try to bury it?
And just distract you with something else. Hey, look at our dessert sales.
Right. If they sweep it under the rug, that is a massive red flag about their integrity.
So you're looking for integrity as much as performance?
In the long run, integrity is performance.
Yeah.
You're also looking for trends. Let's say you see labor costs hurting margins in this year's report. You might panic.
Sure, you'd think the business model is breaking.
But if you go back and read the last 5 years, you might see it's been a slow, manageable trend that they've been successfully offsetting. It turns a cliff into a gentle slope. It's all about context.
So it's about not overreacting to one data point.
Yes. And the MD&A also reveals the KPIs, the key performance indicators, the metrics management actually cares about.
What were the big ones for Texas Roadhouse?
One was comparable restaurant sales growth, or same-store sales.
And that's important because it shows if the existing stores are healthy, not just that they're growing by building new ones.
Exactly. The other was average unit volume, how much cash each restaurant is generating.
So here's a detective question. What if they talk about average unit volume nonstop in 2015, but by 2020, they never mention it again?
That's a huge alarm bell. When a metric disappears from the MD&A, it's almost always because it stopped looking good.
This really is detective work. You're interrogating the document.
You are. You're investigating the health of the business and the character of the people running it.
Okay, we've done the narrative, we've done the time travel, now the numbers. Part 4, the financials.
Right, so you'll see a section called Selected Financial Data, usually a 5-year summary table.
Is this where we start building spreadsheets?
Actually, no. The advice here is to use this mostly as a sanity check.
A sanity check? What do you mean?
Well, most of us use external sites, QuickFS, Yahoo Finance, to get our data quickly.
Sure, it's faster than typing it all out.
But sometimes those sites have errors. So you just quickly glance at this table in the 10K to make sure the revenue number on your screen matches the one in the official document. If it does, great. Move on.
Got it. Don't dwell, just verify.
Then you have the big three: the income statement, balance sheet, and cash flow statement.
And we know these. Income is profit, balance sheet is what you own and owe, cash flow is the actual cash moving around.
Correct. You need these. You have to pull your core numbers from here for any valuation. You can't skip them.
But then we get to the part that I think is designed to make people give up. Notes to consolidated financial statements.
The notes.
It's just pages and pages of tiny text. It looks impossible.
It's often the longest section. And the biggest mistake people make is trying to read it from start to finish.
I just burn out.
They do. The strategy here is incredibly simple. Treat the notes section like a dictionary.
A dictionary. I love that analogy. You don't read a dictionary for fun. You use it when you don't know a word.
Exactly. You only go to the notes when you have a specific question that came up from the MD&A or the financial statements.
Give me a real-world example.
Okay. On the income statement, you see a big line item: marketing spend, $100 million. And you wonder, what is that actually? TV ads, billboards, Google?
The statement itself won't tell you.
No. But you flip to the notes, find the part on marketing, and it will break it down for you. 80% was spent on national TV. Now you know their strategy.
That's powerful. What about debt? That's always a big one.
Crucial. The balance sheet might just say $1 billion in long-term debt. That's a scary number, but it's meaningless without context.
Right. Is it a problem? I have no idea.
So you flip to the notes,
Yeah.
and the notes will tell you the interest rate on that debt, and most importantly, when it's due.
If it's due next year and they don't have the cash, that's a potential bankruptcy.
Exactly.
Yeah.
But if it's due in 2030, it's not an issue. That detail is only in the notes. So if you have no questions, you don't need to read the notes. It's a reference tool, not a novel.
That is genuinely liberating. Okay, part 5. What can we just throw directly into the trash can?
The rubbish bin.
Please tell me there are sections I can completely ignore.
There are. Specifically, look for things like employment agreements.
Wait, but I want to know if the CEO is getting paid too much. That seems important.
You do, but there's usually a summary table for that elsewhere. What Hamish points out is that in the Texas Roadhouse 10K, there was something like 100 pages of pure legal jargon about employment contracts.
100 pages?
Just legalese. If the executive is terminated for cause defined as Section 4, Paragraph B, it adds zero value to your understanding of the business economics.
It's just legal cover.
That's it. It will not help you value the company one bit.
So if I see employment agreements, just keep scrolling.
Scroll right past it. It's a time waster. Focus on the business, not the CEO's severance package legalese.
This whole approach is a game changer. It turns the 10K from this massive chore into more of a precision tool.
It turns it into a treasure map. You just have to know where X marks the spot and ignore the rest of the jungle.
Okay, let's recap the workflow. This is the cheat code for the 10K.
Let's do it.
Step 1, get the 10K from the source, investor relations or the SEC. Step 2, read item 1, business for the current year only.
And skim the past years.
Step 3, read the risk factors once, look for the specific nightmares. Step 4, the big one, time travel through the MD&A for the last 10 years.
That's the most important step for sure.
Step 5, use the financials for core numbers and use the notes only as a dictionary.
Only when you have a question.
And step 6, ignore the legal fluff like employment agreements.
You nailed it. That's the roadmap.
It's funny, the length of the document is almost a smokescreen. The actual signal, the stuff that really matters, is concentrated in just a few spots.
That's the secret. Pro investors aren't speed readers. They are expert information filters. They know what to ignore. They know that 80% of it is compliance and 20% is insight.
And using Texas Roadhouse really brought it home, finding out it costs $5.2 million to build one. That is a concrete fact. It takes the stock market out of the clouds and puts it on the ground.
And that's what investing should be. You're not buying a blinking ticker. You're buying a piece of a real business that spends real money to build real things. The 10K is just the owner's manual.
I love that. So here's a final thought for you, the listener. We talked about reading the MD&A to check for consistency. I challenge you to do it. Pick a company you own. Go download the 10K from 5 or 10 years ago, read what the CEO promised was going to happen, and then look at what actually did.
That is a great exercise. It's the ultimate accountability test. Were they visionaries or were they just guessing?
Exactly. Go be a time traveler. Now, before we sign off, we have some important housekeeping.
Yes, very important.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to listen our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe us on Apple, Spotify Podcasts channel, Deep Value Investing, and deepvalues.ai.
And for our global audience,
Sure, for Apple, Spotify Podcasts, Deep Value Investing, Deep Values up